Winning in Retirement is brought to you by Brian Akers and the Akers Financial Group. This is Talk Radio 680 WCBM and 99.9 FM in Harford County, welcoming you to Winning in Retirement with your host, Brian Akers. Brian is a certified financial planner, professional, and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Welcome to Winning in Retirement, the radio podcast put on by Brian Akers, Akers Financial Group. Brian Akers, that's who I am. I'm a certified financial planner. I'm founder and president of Akers Financial Group. Here with me today is Paul Franco. He'll be our co-host on Winning in Retirement. Good morning, Paul.
Good morning, Brian. How are you?
Doing good. Now, the day's show is we call it Plan to Not Pay Taxes. And we felt as you're starting your tax season, we might as well talk about taxes, even though taxes can be fun if you're getting a refund and quite depressing if you owe money. It's sort of an emotional time of year, but all these forms are coming in, and we want to talk about the concept of plan to not pay taxes. So, Paul, this kind of topic is one of those things you love to talk about.
Sure is. Yeah, this is a passion of mine, passion of ours to talk through about taxes with clients, because this is a big issue that we see. Trying to work through how little tax we can pay, how much tax, and it's a big part of what we do in trying to do tax planning.
Yeah, so one of the things about tax season is that people get things in the mail. So every envelope, you need to give the whole entire tax envelope to your tax accountant so they can read any and all deductions that come from whatever you're doing when it comes to your portfolio, your investments. You want to be able to take advantage of any tax-free item that's possible as you're designing your financial planning. Now, when we're talking about planning to not pay taxes, that does not mean that we're encouraging people not to file. Is that true?
That's true. Correct. There's only certain situations where that's the case, but I'd say 99% of people have to file.
Yeah, so it's not about illegal items. What we're trying to do is the legal ways of paying less tax. Not paying tax on more of your money, trying to pay tax on just some of your money. How you do that, the main topic we're going to say is this, that you can control it to the future. The hardest part about doing taxes for 2024 is it's very hard to control the past. It's very hard to control 2024. What you have to do is understand on the return, there are some things you can put in there, but not a lot changing to the past. What's your thoughts on just regular income tax filings?
Yeah, well, this is that time of year. If you're in the car, you're listening to us, you might have already gotten a lot of the documents. You're going to continue to get the documents. We have a lot of clients who they'll put it in an envelope or a box, depending on what it is. And so gathering the information is so important. But it is crucial to know that even still now, in February of 25, ultimately, we still have some time to be able to make certain changes, make certain contributions to certain investments that can help benefit us tax-wise. And that's really important idea. And so I just want most people to understand that even though we're in 25 now, there's still some stuff we can do to help us with our 24 taxes.
And you're meaning what?
So I'm talking about an example would be making like a Roth contribution. So you can make contributions to your Roth IRA until April 15th of the following tax year. So we could make a 2024 contribution to a Roth, to a traditional IRA, all the way until April 15th, until we file our taxes this year.
And so if you put money in a Roth IRA, that will not help your taxes. That helps you save money tax-free to the future.
Yep.
But a traditional IRA would help, right?
Correct. Yeah.
And it's subject to, if you're in a retirement plan, and all of it's subject to different income limitations.
Sure
so you
is.
got to know all your rules. Now, if you're a small business owner or have Schedule C, those are the people that can really sort of wait until this time and then see what their net profit is and see if they want to do a SEP IRA or something else. What that allows them to pay for last year. Besides that, it's very, very hard to come up with any extra deductions that you didn't already pay in. The key advice in tax filing is to have all your information, to get your mileage for medical, your mileage for charity, your mileage for work, and keeping track of that for all the last year and understanding that's all part of what you turn in when you do your tax return. Now, Paul, can you explain the emotional effect of owing, or some people who really want to try to get a $1 refund, and what's the advantage or disadvantage of any of that?
Yeah, I would say it's so dependent on the individual, but the reality is that in my opinion, and this is different for everybody, I think ideal sort of perfect tax planning is trying to keep you at that refund or owing a very, very little bit. Meaning if we don't get a big refund, that means we kept that money throughout the year. Now, I'm saying that generally, Brian, because there's certain situations where a lot of times for spending, for big spenders, we can utilize that refund as a kind of an additional savings. And so, in my opinion, generally, my advice would be to try to target a small refund, or even owing a little bit is okay at tax time. We don't want you to get a big refund. We don't want you to owe a ton of money at tax time.
Yeah, so the idea is being penalty proof. There's actually a penalty if you don't pay in enough, and they don't reward you for getting a big refund, so you don't get any extra for having a big refund. The big refund, if you don't file on time, you can get some interest on it over the years. But generally, if you owe money and you owe more than what you had paid in the year before, there are certain rules that will apply to a tax penalty that you do have to watch that. And that's why we don't want to owe a lot, especially if you did owe a lot last year and you didn't pay it in this year. You got to make sure you pay on what you assume you might do.
Yeah,
might owe.
I would say, Brian, it's critical, and I know most people know this, but in case you don't, the reality is even if you think you're going to owe in April and you might not think you're able to make those payments, and you're like, well, I can do an extension till October, it is crucial to file by April 15th. To file, even if you don't pay it until October, pay it throughout the year, you need to file by April 15th, because there's a penalty for that too, for not filing.
Now, most people that put it off believe they owe money. And so that's always interesting to see where they are emotionally when it comes to their taxes. But putting it off because they owe, that makes sense. You don't have to pay to the last day. But making sure you get it done and get it out is a really important thing. Now, when it comes to a tax return, I think one of the items that people need to know is about the idea of a standard deduction versus itemized deduction. Could you just sort of explain what they are now under the current tax law?
Sure. So the standard deduction now for 2025 is $30,000. If you're under the age of 65, but then there's an additional benefit you get if you're over the age of 65, or if you're blind, an extra $1,300, or actually it's actually an additional $1,600 per person. So if you're a married couple listening to this and you're 65 and older, your standard deduction would be $33,200. And so that would be the deduction you're able to take when you take a look at your adjusted gross income and you subtract off that deduction, the standard deduction, to figure out what your taxable income is for that year. Now, for itemized deduction, it works a little differently. When you itemize a deduction, it takes a look at a few key points. It takes a look at your medical cost up to a certain degree. It takes a look at your state and local tax. It's called the SALT tax, which is capped at $10,000 right now. And then it also takes a look at your mortgage interest. You can deduct mortgage interest as far as an itemized deduction, and then charitable contributions. And so between those four big categories, if that number with those deductions, when you add those up, is equal to or more than the standard deduction, your tax preparer, your CPA is going to take a look at that and try to work through which of the two you want to take. Do you want to take the standard, or do you want to itemize?
Most people are filing and taking a standard deduction nowadays because they combined it under a tax law called the Tax Cut and Job Act of 2018. And that's a law that expires at the end of the year. And one of the thoughts is that the current Congress will approve the extension of this law into next year so that we don't revert back to 2017 tax brackets and the 2017 itemization and splitting the deductions back out again.
Yeah, well said. And it would be interesting what they'll end up taking from that 2017 Tax Cut and Jobs Act and keeping versus getting rid of it.
Yeah, and that will be a radio show in the future this year. Right now, we don't like having radio shows based on guessing and hoping and wishing and what it might be or could be.
Right.
We like using the actual tax law, the tax code that's going on, and explaining what we want to do. So the mindset is this. We believe at Acres Financial Group that you need to plan to not pay taxes. Now, that does not mean we don't pay tax at some point in time. We need to decide how we're going to pay our tax, when we're going to pay our tax. We truly want to have control over the taxation of our money. Now, there's some things we can control. There's some things we can't. So the idea is this. As we go through the basics of some taxes this show, we want you to understand the concept of controlling paying tax now and maybe never again, through all the ideas of Rothification, Roth conversions, Roth contributions, all kinds of things.
Yeah, it's so important because most people don't realize you do have that control. And when you don't have a plan in place, what happens is you get surprised later. And that's what we try to avoid at all costs. I don't want to be surprised with, hey, I need to pay all these taxes later. Let's plan it now.
All right, so just some hints with your filing your 2024. Make sure you got all your information. Make sure you tell whoever's doing your taxes everything, all the stories, all the changes in life. Oh, my kids are living with me, the deductions. You got to say things such as charity, any extra charitable work you did. Do you know if you fly to do charitable work, you can deduct the flight as a charitable deduction?
I did not know that.
You can't deduct your time while you're doing it. You can't deduct your hourly wage, but you can deduct your travel expense to be able to do do charity, which is great. Some of the things that people forget about is when you take mortgage interest, you have your mortgage, you have your home equity. Second homes can count under that category up to a certain limit. Also, an RV, a camper that has kitchens and bathrooms, tents don't count. But the interest on that can all be counted under your itemized deduction as a possibility. So when we're talking about planning your taxes, when we're talking about 2024, you have to understand we can only go back and find the records and do the best you can with what you did last year. But we want you, while you're doing the 2024 taxes, to think about 2025 and then think about your future self and how the idea of not paying tax would sure be nice, especially in those retirement years. So as we go through this whole concept of our day with the plan not to pay taxes on our radio show today, we want you to understand where we're coming from. We want you to help you control what you can control and understand what taxes affect you and ways to actually do even better. Now, Acres Financial Group, we're a local company. What we mean by local is here in Maryland, we have offices in Lutherville, Forest Hill. We do meet clients all around the state. We do meet clients all around the Mid-Atlantic region, multiple states. We have clients around 30-some different states, and, of course, a few clients around the world. We want you to begin winning in retirement. One of the big ways to win in retirement is to keep that money for yourself and to not give as too much to taxes. Try to limit the tax exposure in your retirement years. So make sure that you begin winning in retirement by calling us at Acres Financial Group to begin a process of getting to know us and to take advantage of a free meeting with one of our team of advisors. You go ahead and call us at 833-WIN-RETIRE. That's 833-WINRETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to acresfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. What is your tax bracket? Do you know? We'll talk about this in a moment.
Tune in nights to Red Eye Radio with Eric Harley.
It should be clear to everybody by now that his public service has always been all about him and his family.
And Gary McNamara.
It just showed how cold and callous he can be.
Real, live radio in the deep of the night, right here. Red Eye Radio is on every morning from 1 to 5 on Talk Radio 680 WCBM and 99.9 FM in Harford County. This is Talk Radio 680 WCBM and 99.9 FM in Harford County, welcoming you back to winning in retirement. Call 833-WIN-RETIRE. That's 833-WIN-RETIRE. Call now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers from Akers Financial Group. I'm a certified financial planner practitioner, and here with me today is our financial advisor, Paul Franco. He's a co-host. He's got his MBA. He's been with Akers Financial Group for more than 8 years, working with our clients, and we enjoy having him at our company, and we enjoy having him on their radio show. And because of his expertise and his abilities to work with a client and to apply their situation to the best planning advice that we can. So, Paul Franco, good morning for second quarter. You ready to go?
I'm ready to go.
Second quarters are tough sometimes because you get excited at first and then you sort of lean back, relax a little too much. But I'm going to hit you with a hard subject this one.
Sure.
Are you really ready?
I think so.
You don't sound excited, though.
Well, it's exciting, but the reality is that, hey, the second quarter, you make your adjustments from the first quarter, you keep moving forward, and then
I didn't hear the excitement there. Oh my! So All right, so this is going to be my question for Paul Franco, and that is this: when we're talking to people about tax bracket and what is their tax bracket. So you guys listening out there, wherever you're driving, what is your tax bracket? Do you know what your tax bracket is? So we're going to ask Paul Franco to tell us what is a tax bracket.
Sure. Yeah, so a tax bracket in its definition is basically you would take a look to figure out what your tax bracket is. You take a look at your taxable income. So let's just say you have a $100,000 a year salary, and let's say you made no contributions, no deductions, and just a raw $100,000 a year. That's what shows up as your wage number. What happens is you subtract out the deduction. So you would subtract out the standard deduction, let's say for this example, of $30,000 if you're under the age of 65. And so your taxable income would be, for generalization purposes, $70,000. And so what happens is you can take a look at that taxable income number and run it against the tax bracket. The numbers that get adjusted each year to figure out what your real bracket is. So in that situation, $70,000 a year of taxable income, you would be in the 12% bracket because your taxable income is between $23,851 all the way up to $96,950. And that's using somebody for a married file joint. Now, if you're single, your bracket might be different because you're using different numbers in that calculation. So if you're a single individual and you have that same $70,000 a year income, your tax bracket falls in the 22% level because you're in the taxable income between $48,476 all the way up to $103,350. And so that's the basic of tax bracket is you take a look at your taxable income and then you compare that to those tax brackets that the IRS publishes each year.
Alrighty, so when you're trying to explain just the basics of the federal taxes, do you use steps or what kind of concept do you do when you're trying to explain the different brackets?
Yeah, so a lot of people that come in, Brian, they think, well, Paul, I'm in the 24% tax bracket. My wife and I, between the two of us, we have a taxable income of about $225,000. Ultimately, does that mean I pay tax all at the 24% bracket? The answer would actually be no, because just like you mentioned, Brian, those tax brackets are tiered. So because they're tiered, what that means is that the first $0 all the way up to $23,850 is actually taxed at the 10%. And then the next level, the next dollar above that, $23,851 all the way to $96,950 is taxed at the 12%. And then the next dollar above that, $96,951 all the way up to $206,700 is taxed at the 22%. And then that means there's only a small level that's actually taxed at the 24% because the next dollar above that is $206,701 all the way up to $394,600 in the 24% bracket. So what that means is that roughly $10,000, $15,000, $20,000 of income that puts you in the 24% tax bracket, ultimately your entire income's not taxed at that level. It's tiered. And that's how I explain it.
Yeah, so I like to think about taxes and try to simplify whatever way possible. The hardest thing about knowing your tax bracket is you got to look at your tax return first. A lot of returns, what you'll see is if you don't put a senior return, because that stretches it out to 2 pages or more, but a regular 1040, if you look at the very bottom, it'll say the word taxable income. And if you look above that, you'll see adjusted gross income, then you'll see standard itemized, you'll see some more deductions, and you'll see taxable income. That taxable income is the income we're talking about. So if someone's actually at the top of the 12% bracket, and that's like $96,950 for married filing jointly, they actually can make, if they're over 65, they can actually make like $33,000 above that and still be in that level because of the deductions. If they're single, then they only get half of that, like 15 plus the 2,000, I think. So it'd be like 17,000. But the idea is this, is that taxable income is what happens when they're going to calculate your taxes, and your taxes are like a step. Your first bit is on the first step at 10%, next bit's at 12%, and then that next step is a real high step. You know, it's almost like you're a little kid and you're trying to climb up a step, and you know it's just huge. You got to jump to it. Well, that jump is from 12% to 22. And so when we're doing planning, we want to know what step are you on? What is your bracket? So we can know the next dollar, what are you going to be taxed at? So what we want to do is just teach you some of the tricks that we do. Because this show is called Plan to Not Pay Taxes. Well, in most cases, you got to choose more about when you're going to pay your tax. So if we can get more money at a 12% bracket and then avoid future taxation at a 22% bracket, we win this planning tax game. I think that's a lot of fun to do, right, Paul?
Absolutely. And that's the whole goal, is to pay the least amount of tax over your lifetime. And that's what we call levelizing your taxes.
Yeah, so as a financial planner, we call the next dollar taxation, what's the fancy term that you like to use?
I don't know if I'm following you. What do you mean by that?
All right, so if I'm in another bracket, my marginal tax rate will be 22
Sure.
on the last dollar. If you actually are looking at your total return, that's called your effective tax rate,
Yes.
where you average it out.
Correct.
The averaging of it is the total value of it. Marginal tax bracket is the next dollar you make. What bracket is that at? That is what we look at to understand where we are now and where we're going to be in the future. One of the things that happens is clients will come in to see us, and they will be almost retirement poor in the fact that they've actually saved so much pre-tax, and they are probably a 401k millionaire, and then they realize, oh, I'm getting ready to be 70, 73 years old. I got to start taking money out. And all of a sudden, all this is going to now be forced to come out and be taxed. And that's going to force them to a newer bracket. And so this marginal bracket, the highest bracket, starts to kick in at 22, 24. And they were paying 12 for a lot of their time in retirement because they didn't need the money. But if you have all of your money in pre-tax retirement and you actually are retired, you could actually see yourself at a higher bracket throughout those retirement years. And what we're trying to do is let's control those taxes, control what we're paying, control how we're doing things by doing proper planning. That proper planning is understanding what is your tax bracket now and what do you think your tax bracket will be in retirement. Now, what do you think with people? Do they go down in retirement? What do you usually see, Paul?
Well, generally, the idea is we try to keep your income, we try to keep your standard of living, your income around the same in retirement. So that way you don't have to adjust anything like that. But the real issue, Brian, and I see this a lot now, which is a terrible reality, is like, well, imagine if you've been in the 12% bracket, your whole life, even throughout your retirement years, or in the 22%. And the next thing you know, you have a spouse pass away. And now your tax bracket cuts in half, and now you're getting the same level of income, albeit maybe some adjustments. But now you're paying. If you're from the 12%, now you might be in the 22%, the 22%, like you mentioned, Brian. The reality is that that's a big bump. That's a 10% bump on your tax bracket, just because ultimately you had one spouse pass away. Now your deductions, your bracket's much less. And so, for retirees, our goal is that. The reality is that we want to have the income that we flow. We want it to almost replace your paycheck you've been getting your whole life. And so because of that, we have to watch your taxes. And you mentioned, Brian, the RMDs, required minimum distributions that you're required to take out when you're 73 or 75, depending on the year you were born. The reality is that that's a new layer of income that has the complete ability to bump you into a tax bracket when you don't want it to. It also has the ability to bump you into paying more Medicare premium. And that's a whole nother conversation. So the reality is that we have to watch your income. We like to pay tax now. If we anticipate your bracket's going to go up over time, we like to pay tax now and never again. And that's our whole goal.
Yeah, so when you think about those that are still working and you're looking at your 401k and your taxes and you're saying, well, where am I at now? So knowing your tax bracket will give you some answers to what you need to do. So understand that if your bracket is 12% now, you probably should do Roth IRA now, Roth 401k, Roth TSB, because you're in that bracket, and then when you retire, you got to plan based on what you've saved, what bracket you'll be in at that time. And so a Roth IRA, you pay tax now at your current bracket, and then all of it's your money in retirement. We think that's a big deal, that this money you set aside becomes your money. A Roth account, if there's $500,000 in there, that's your $500,000. If it's pre-tax and you have a couple $1,000,000 in a 401k, what happens is that a third of it is someone else's. It's the federal and the state that you live in. It's not all yours. So what we're trying to do today is talk about a plan to not pay taxes. And the answer really is not to pay more taxes than you should. So understanding the tax bracket you're in today, the tax bracket that you'll be in retirement, and then making financial planning decisions is the key advice that we're giving during this quarter. Because we all know when we get to retirement, the best part of retirement is going to be getting our time back, where you decide how to use it. Before retirement, your time is tied up with other commitments, mainly your job. A lot of that goes away in your retirement. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement. Go to our website at acresfinancialgroup.com, scroll to the schedule a meeting section, and let us know you'd like to schedule your free consultation with one of our team of advisors. That's acresfinancialgroup.com, or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person meeting. Go to acresfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. Why do you owe on your tax return? We'll explain when we get back in a minute.
Hey, so what's a great way to spread awareness that driving high is illegal everywhere? A catchy song, of course.
You can run, but you can't drive high. You can run, but you can't drive high.
Friendly reminder, don't drive high. If you feel different, you drive different. Brought to you by NHTSA and the Ad Council.
This is Talk Radio 680 WCBM and 99.9 FM in Harford County, welcoming you back to winning in retirement. Call 833-WIN-RETIRE. That's 833-WIN-RETIRE. Call now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Indeed. Welcome back to Winning in Retirement. I am Brian Akers from Akers Financial Group. Here with me today is Paul Franco, also from Akers Financial Group. We are financial advisors that help our clients take them from where they are to where they need to be. So today's show is called Plan to Not Pay Taxes. And in reality, if you don't plan to not pay taxes, you're probably going to pay more taxes than you should. So as we put together this show today, we try to cover different things to help us explain to you how we go about doing it. And one of the things we want to do this quarter is to cover this question about why do you owe on your tax return? And Paul Franco, that's going to be my question to start out this quarter, is why do you owe on your tax return?
Well, the general answer, Brian, is that we aren't withholding enough throughout the year.
So you didn't pay enough.
You didn't pay enough throughout the year, so now you have to owe come tax time. The same reason, why did I get a big refund? You withheld too much throughout the year. And so there's planning we can do to make sure that we are withholding the appropriate amount of taxes throughout the year, so that way you don't owe a ton of money come tax time.
Yeah, so examples of this, I was trying to think about people that owe a lot. They're never happy when they owe. Then the thing is that they think it's the tax person's problem. They calculate it wrong. But the reality, it's a matter of what went in and what goes in the return calculation. If you don't put enough money away to the tax return, it's just not there.
Yeah, and Brian, I would even say even what makes a client even more mad is when you get surprised of how much you owe. Mm-hmm. Like you think you withheld enough throughout the year, and then you get hit with certain surprises of an example being like dividends and interest, stuff that generally they don't take any tax out of, and then you get surprised. It's like, wow, that I paid a lot of tax on that.
So that's an example of a mutual fund that had a good trading year and had a large capital gain, and they pay it out on 12/31, and all of a sudden there's this huge capital gain that gets right to your tax return if the account is held personally by somebody. Right. And so that's a surprise, right?
And I hate those types of surprises. And that's like, imagine if it's a $15,000, $20,000 capital gain, and ultimately there's no withholding that comes out of there. And you didn't withhold enough throughout the year. That's likely gonna make you owe come tax time.
And then when people take their money out of savings, they go to online banking or the ladder CDs, they go from 0 to 4%. All of a sudden, they've created more interest that's just fully taxable.
Yeah, and that's exactly what we've been seeing a lot of now, Brian, in 2025, because the past few years, ever since they raised interest rates in 2022, we can get 4 or 5% on our money market and CDs. The reality is that, well, you have to pay tax on that.
Well, how do we plan not to pay tax on it?
Yeah, well, my answer is one, in trying to do one tax efficient investing. So if you're in a higher bracket, do if more efficient investing and not have to deal with the CDs and interest that all kick out those big interest bills at the end of the year. And then if we're doing investing in mutual funds, any type of investments like that, we try to do more tax efficient investing in funds that, or even not in mutual funds, having the ability to not kick out those capital gains. So there's ways, and that's something we do a lot of, Brian, is that idea of how to be more tax efficient in our investing strategies.
Now, the use of ETFs has allowed for tax efficient. We have a portfolio called Tax Aware, where we use ETFs as a way to not have the mutual fund kick out of dividends and tax at the end of every year, but to be more efficient on the taxable accounts. It's very important for trust, large trust, irrevocable trust, trying not to kick in capital gains, which shows at a very high tax rate if you have trust. So this idea of taxation on your interest and dividends, you need to understand where your money is dictates the rules on the taxation. If your money's in a CD, you pay tax as you earn it. If your money is in a treasury bill, when do you pay tax, Paul?
If it's on a treasury bill, you only pay tax on the federal. You don't pay any state income tax.
Yeah, so you don't pay state or local.
Yep.
So if Maryland taxes were going up, you would actually wouldn't pay that tax on the interest you make. So that makes, if they both had the same yield, the tax efficient one is the treasury.
Right. And for the ultra high net worth, Brian, you can talk about if in like the state of Maryland municipal bonds that are 0%, they're triple tax free, no federal, state, or local.
Yeah, so if you're a resident of Maryland, if you own a municipal bond from Maryland, then you don't pay the federal or local. If you want to not pay just federal, then you just have municipal bonds anywhere around the country, which is less risk to diversify your money around the different states.
Yeah, but this is why they call us to be able to help guide them on what the right investments are, the right tools to not only grow their wealth, grow their money, but also to pay the least amount of tax possible.
I had a couple cases where if you actually take your CD money, or you don't really need it anymore, you hate paying tax, but you want it for the kids later. I had a client actually put into a life insurance policy, which would basically double the death benefit, made it totally tax-free now and tax-free when they pass away. It was a way of building a legacy with money that was kicking their return every year.
Yeah.
It was actually triggering above that limit for IRMA, which made their Medicare premium show up. So that was an interesting case where we're looking at taxation to the future just being higher and higher and higher, and we didn't know. I had to come up with a way to do it. And one idea was to shield money from ever being taxed again through the use of life insurance. That was just an interesting case that one of the ones we did last year. Taxes are like a little bit like a game to us, I guess. There's the rules. We abide by all the rules. We just want to make sure we understand you, the client, and your exact situation to help us guide you into paying the least amount of tax, which is very, very important.
And I think that's key what you said there, Brian, is that idea of the least amount of tax. Because I get a lot of, how do I pay no tax? How do I pay zero? And one, you're always going to either pay tax at one point. You're either going to pay tax now and never again, or you're going to not pay tax now and have to pay the tax later. There's only a handful of investments out there that you actually pay zero tax on.
Yeah, so the question of the quarter is, why do you owe on your tax return? Another reason people owe is because of multiple W-2s, or we have a spouses where they make differential of income. One might make higher, one might be lower. And the thing about a tax return, they add them all together, and then last quarter we talked about tax brackets. So if you're at a job and you're making in the 12% bracket at that job, they withhold at a 12% bracket. Then when you get ready to do your return, you combine with a spouse or with other W-2s all together, and all of a sudden you start growing into the next bracket. There's not enough taken out, and surprise, surprise, you owe more tax.
And you know what's worse, Brian? And that you're exactly right. And imagine if you have you're a W-2 as one spouse, and then your spouse is self-employed, and he or she is supposed to be making quarterly payments, or they don't make enough.
Yeah.
And so you're taking some out of yours. You're like, I'm taking the appropriate amount of tax out of mine. But when you look at your spouse's, they didn't take nearly enough out. That all comes into that's a big reason why you might owe come tax time.
Yeah, so understanding your taxes and having a game plan for it. If the spouses basically want to argue with each other about who owes the tax, the problem is that if one makes more than the other, then you truly have to do a little bit of a calculation. But the hardest part is we have to withhold to be able to net out a small refund would be a goal. We don't recommend large refunds because we think you should have the money, keep as much as you can. We don't recommend getting penaltied. Having a penalty for not paying in enough. So balancing that out is very, very important.
Yeah, well said. It's all about, again, it's just when you look at a tax return, generally this is the big thing, Brian. It's like when your tax return's done, you take a look at it and you're like, oh, no, I owed, or oh, no, I got a big refund. And a lot of people, what they do is they kind of ignore it and they strike it up to, oh, I get a big refund each year. Oh, I owe a lot come tax time. The reality, though, is that we can do the tax planning now throughout the year so that we can fix that to the future. And that's a big goal and big benefit we give to our clients.
I had a client come in and they're like, oh, why did we owe all this money last year? And they were a brand new client of this within the last month. But in 2023, they actually owed a lot of money because they showed too much income when they were trying to do the health care. So they retired and they did health care through the Affordable Care Act where they got subsidy. They signed up for a subsidy. And then all of a sudden, $4,000 hit on the return at the end of the year. They had like in 1 year interest of like $500. Then all of a sudden the interest went up to $5,000. Everything started piling on to them. That's why they owed like $8,000.
Yeah.
As that was painful, especially they retired. And it's like, why do we owe now? Shouldn't we pay less than retirement? It was a bit of a pain for them. The hardest part when it comes to all of this is making sure you fill out your W-4 if you're still working to know that you put enough in. Can you explain the basics of a W-4 to us, Paul?
Sure. So if you look at your return and you're like, I want to withhold more throughout the year, generally your employer is going to require you to fill out a form W-4 where you can actually plug in some numbers. You can plug in some income numbers if you're married or if you're single. And then also by calculating that and by doing that, it'll determine how much tax they do withhold throughout the year. So you could have certain allowances. If you're married, if you have 2 kids, you might be able to take 2 allowances. And so when you have more allowances, they take less tax out. If you have 0 allowance or if you're doing a single at a 0, they're going to take the most amount of tax out. And so there's ways we can try to withhold more throughout the year utilizing that W-4 form.
Yeah, so one idea is that there's an option on those returns on the W-4 where you can actually say, put me down as married and 0 plus $100 or plus 25.
Yep.
So let's say you're working a side job, and that side job you work sometimes, but they never take any tax out because you don't make enough because you only work a few hours. You could have them take a flat tax out, $25, $50. And so that's throwing money to your tax return to the future so you don't get hit the next year, which is very important.
Yeah, and I see that. I had an example of that, Brian, where I had a client of mine that has been working his normal job, and then he has a security job on the side that he gets 1099 income that he didn't do any withholding out of. And that was one benefit of, hey, we took a look at his W-4 of his employer, where his vast majority of income comes, and we started to take out $200 a pay more to cover that cost.
And what happens is you go into your accountant and all of a sudden you owe, and then you might make a bad financial decision. What I mean by that is this: instead of funding a Roth IRA, you might switch it to a traditional IRA so that you can get a deduction so you don't owe as much. And then the problem is you're just postponing that tax till later. So we don't want because you owe money, we don't want you to end up having to avoid the Roth idea. We love the Roth idea.
Yeah.
So when we're talking taxes and why do you owe, those are just some reasons. Of course, the reasons are your individual reason. Anytime we meet with you, we'd love to go over your exact situation, knowing what tax returns the last 3 years, so we have a chance to correct things any chance we get. Now, when we're talking about taxes, we're talking about you and your situation. We help you control what's going on, help you understand by controlling your tax today, you can control that tax in the future. This is what we do for a living. We don't have to make you figure it all out. We want to help you figure this out. So let us help you. So go ahead and sign up for a meeting with one of us, one of our team of advisors here at Acres Financial Group, so that we can help you with any type of planning, but especially tax planning. You can give us a call at 833-WIN-RETIRE and schedule an in-person meeting with one of our team of advisors. That's 833-WIN-RETIRE, 833-946-7384. In retirement, can you pay less in tax than your neighbor? We will explain when we return.
From Annapolis to Catonsville, from Dundalk to Reisterstown, from Bel Air to Glen Burnie, and from Fort McHenry and the home of the Star-Spangled Banner, this is the right choice for Maryland.
Talk Radio 680 WCBM.
This is Talk Radio 680 WCBM and 99.9 FM in Harford County, welcoming you back to winning in retirement. Call 833-WIN-RETIRE. That's 833-WIN-RETIRE. Call now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers. Today with me, I have Paul Franco. We're financial advisors through Akers Financial Group. Our IA is Arcadios Wealth. Our broker-dealers, Arcadios Capital. All kinds of affiliations, licenses that gives us the ability to work with our clients, to help them in where they are, to take them to where they need to be. Financial planning is what leads our decisions, our talk. What we try to do for people is understand the plan, and then we implement the plan by being licensed to do that implementation. Active money management, providing ability to buy insurance when it's needed, to buy protected investments when needed, and building a plan. Taxes drive a lot of the planning. And so Paul Franco and I today have been going over, this show has been called Plan Not to Pay Taxes. If you missed any of it, you can go to our website at AkersFinancialGroup.com. That's Akers, A-K-E-R-S, financialgroup.com. You go on that website, hit the radio podcasts, and right there is all of our shows. You can pick one of them or hear this one again. It'll be right on the website pretty soon here. Now, on that website, you can also find that you can go to any podcast site and hear this recording once again. All right, so the fourth quarter here, we have a tough topic, and that is this, Paul. In retirement, can you pay less in tax than your neighbor? What's your thoughts?
Well, the answer is yes. You can pay less tax than your neighbor. And our goal is to try to explain ways to, and we want you to be able to call us and help us work through these plans so that you can.
All right, so you're out in the yard. Let's say you're both just got done taxes, so let's call it spring. Both people are done taxes, and you're having a conversation. How does that conversation go?
Yeah, it depends on what it is. I could play the one individual of, you're cutting your grass, you're doing what you do with, and you're looking at your neighbor, and the whole time you're thinking, oh no, I have such a big tax bill. And then the other one might look at you and say, no, I don't have a big tax bill. And so it definitely does depend on each situation.
Yeah, when that neighbor pulls up in a new car and then he keeps talking about how low taxes he's paying, you're like, hey, what are you doing? How are you getting that money?
Right.
Where are you getting the money to do this? You're doing that new addition right next to my house. We have the same house. We make the same income. We have the same jobs. Why is this so different?
Yeah, well said. And that's the reality is that it's because one did the tax planning and the other one didn't.
Yeah. So what kind of tax planning are you talking about when we talk about they did the tax plan? What are your thoughts there? Well,
in that situation, my idea would be that means more of their money, because that scenario, Brian, of you earn the same amount of income, you have the same amount of your nest egg saved up. That tells me that more of their nest egg is theirs, meaning they have more Roth, they have more tax-free, and so that way they can afford more and have more of that nest egg they work so hard to build up to be able to use that as income. Whereas the other one, like you mentioned before, it's like a third of it is going to have to go to tax, and that's a big bill when you're talking about $1 million 401k, $1 million IRAs.
Yeah, like when you see someone with $3 million in their 401k, and it's all pre-taxed. It's like, well, you're going to be pulling out $120,000. That's going to jump you on higher brackets. Are you ready for that? And if we have enough time, we can start doing Roth conversions and nibbling that down. That's hard to do to work on this whole levelization of taxation over time. But the idea is plan now so that you can pay less tax in the future. If we can do proper planning, there's some amazing ideas that we can do. Now, you have some ideas you want to cover for those that are retired and as they get into that RMD stage.
Yeah, I think that's a big part of what we do, and I think it's key for people who are pre-retirees getting ready to retire, and then also early in their retirement. So, like, give a scenario where somebody retires at 65, And so if they retire at 65 using today's age, then they would be required to take their distributions, RMDs, from their retirement accounts at age 73. And a situation like that means we have 8 years. We have 8 years where we can do something called Roth converting, where we're taking the pre-tax bucket that you've built up and taking some of that money and converting it to Roth, paying tax on it now and never again, having that money grow tax-free. So that as we get closer to RMDs, and when we eventually get to that point where we have to take our required distribution, our pre-tax bucket might be 30, 40% less because we increased our Roth bucket by that much more proportionally. And so now our RMD is less because we paid tax on that now and never again. And especially, Brian, when we have situations of clients who have great sources of income when they retire, whether it be Social Security and pension, or maybe multiple Social Securities if you're married, multiple pensions. The reality is that what you've worked so hard to build up, you might think, oh, I'm never going to need to touch that. I'm going to use that for any emergencies as I need to. The reality, though, is, Brian, at 73 or 75, the IRS makes you take those withdrawals. And those become withdrawals that you have to take and pay tax on, even though you don't want to. So we can do that tax planning of one example is the Roth, and that's a big example. And then there are others as well that we can talk about.
Yeah, so when someone's at RMD age, 73 years old or older, they have to take a withdrawal. Is there any way to avoid the taxes?
Yeah, the benefit is if you're over 70 and a half, which you would be if you're RMD eligible, and you give to charity or you're charitably inclined, you can do something called a qualified charitable distribution, a QCD, where you take that RMD. Let's say the scenario, let's say it's $1 million portfolio you have in IRA that's subject to RMDs. That's about $40,000 that you'd have to do. It's a little less than that, $40,000 based on the required distribution using your life expectancy tables. So that's $40,000 that you have to take out of your IRA. The reality is that you might say, Paul, I give $10,000 to charity already. I give $10,000 to charity right out of my checkbook. And so my argument would be, well, if we do that and we're already taking the standard deduction, there really is no tax benefit. And so what can we do? We can do something called a QCD where we're basically saying, okay, $40,000 is our RMD. We're going to use $10,000 of that to give to charity, to give to your church, give to a local charity, whatever charitable charity that you give to. And then that would be 100% tax-free, the amount you give out of the IRA to the charity, and it would help satisfy your RMD.
All right, Paul. So you dropped some symbols there: the IRA, the RMD, the QCD.
Sure.
On the QT. All right.
Too many of them.
So we're just going to walk through it.
Sure.
RMD, required minimum distribution. So Roth IRAs do not have a required minimum distribution.
Correct.
But if you do pre-tax, where you take a deduction now, let your money grow over your lifetime, the matching that's done at work, all that'll grow pre-tax. There's going to come a day when you have to pull money out before you pass away. The IRS loves to make sure you pay something. This used to be 70 and a half. It used to be 72, and then they move it to 73. And if you're born in the 1960s or later, you don't have to do this till you're 75. But one of the big things that we love doing at Acres Financial Group is to help people give to charity. And they can give to charity, and they call the RMD, the required minimum distribution, a QCD that goes to charity. Qualified Charitable Distribution, a QCD, and that could be to multiple charities out of your IRA. So what we're doing is we're taking money that's never been taxed before and we're sending it to a charity. We don't get the deduction, but it doesn't show up on your income tax as income.
And that's the beauty, is actually that you don't get the deduction. And that's what I really find, because
that's beauty?
It sure is. And let me explain why. Is this idea of, hey, the standard deduction's 30, if you're over 65, it's $33,200. So you have to give a lot to charity. You have to have a high medical. You have to have a $10,000 cap on the SALT tax, the state and local tax, to even take that benefit as a charitable deduction and to be able to deduct that. So if we can have a direct reduction off our income, have it be tax-free, and still take the $33,000 standard deduction, that's really good tax planning.
Right. So qualified charitable distributions, per person, there's a limit. In 2025, the limit is $108,000 per person. So we just can't give whatever we want out of our IRA. We can give more than what's required minimum. So you can give more than that, depending on what you want to accomplish in your charitable giving.
Right.
charitable giving, if you have a heart for that, I believe it's a wonderful way to lower your taxes. To plan to not pay taxes is instead of you get a check, you get your paycheck, and then after you pay your taxes, you write a check to your local church, and then you don't deduct it. All of a sudden, that's out of your budget, and that's taxable, and you pay it and no deduction. And that doesn't. I know you probably don't do it for the deduction, but it'd be nicer if you had a deduction. This is a way where we're using money that's never been taxed before. We give it to charity, and we avoid it. It's a wonderful way to be.
It sure is. Yeah.
Yeah, so this is one of the ideas when you're already at that age, already wanting to take withdrawals and you're facing taxes. The thing is that if you're already in your 70s, we can't go back and fix things. But if you're younger and you have the ability to say, hey, if I pay tax now, then let this money grow 10, 20, 40 years from now, that's going to be tax-free. That's my money.
And the cool thing is, even if you're in your late 60s, early 70s, leading up to RMDs, there are still ways that we can lessen that required distribution in the future. We can do Roth conversions where we're paying tax now. We take a look at your tax bracket if you're in the 22% tax bracket, and we see how much room we have to convert and keep you in that bracket without affecting other benefits. And so that's a big benefit. We can still do the planning now so that we can lessen our tax bill to the future.
Yeah, the sad part is that in retirement, yes, we do have to pay taxes. Unless we have no money or no money coming in at all, then we don't have to. But if you're using your savings account, you don't pay tax on that. You don't pay tax on a gift. But if you're in retirement, there's still the tax return, still taxation that you have to pay. So how do we avoid that? Well, a lot of it has to do with your planning while you're working. So at Acres Financial Group, we want to help you with that planning while you're working, and also the year-by-year planning on what is the most effective way to pay the least amount of tax. How to plan it so that you're not paying taxes that you don't need to. That's the goal, right?
That sure is. And pay the least amount of tax possible over your lifetime. That is perfect tax planning.
Sometimes it's counter to a CPA in that they'll do a return and they're trying to look at that year, trying to net out the least amount of tax for the year without the future in mind. And so as a planner, we are looking at your future and your current. And sometimes we actually do want to pay more tax now.
Yeah, absolutely. Well said.
Well, we do thank you for listening to our show today. Good job, Paul. Our show is called Plan to Not Pay Taxes, and our show is called Winning in Retirement. Thank you very much for all listening. We look forward to meeting with you. We want you to win in your retirement by taking advantage of the opportunity to begin planning with us at Acres Financial Group. To schedule your free meeting with one of our team of advisors, go to our website at acresfinancialgroup.com. Scroll to the Schedule a Meeting section and let us know you'd like to schedule your free meeting. That's acresfinancialgroup.com, or call us at 833-WIN-RETIRE. That's 833-WINRETIRE. We'll give you a call on Monday to schedule your free in-person meeting with one of our team of advisors. Start planning for your retirement now. Go to acresfinancialgroup.com or call us at 833-946-7384. Thank you for listening. I'm Brian Akers from Acres Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Acres Financial Group. Acres Financial Group offers securities through Arcadios Capital, an SIPC and FINRA member firm. Advisory services are provided through Arcadios and do not share any common ownership. Neither Arcadios nor Acres Financial Group provides tax or legal advice. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and/or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.